I am happy to kick off another Random Walk podcast, which I do from now and again, every now and again. I've got with me, very, very happy to have with me, actually, Billy Libby, who's the CEO of Upper90. I'm going to let Billy sort of talk a little bit more about what Upper90 does and a few other things. But generally speaking, like this sort of sounds in the Random Walk series of new and different in capital markets and people thinking about their alternative financing structures or just doing things a little bit differently than the same old, same old. And I think, again, I'll let Billy take it away, but I think that definitely is a fair description of what Upper90 is doing. So thanks for joining me.
No, thanks for having me. It's been great to get to know you over the last several months, and it's timely. I think Upper90, we've just been going through an internal exercise of how to make it more clear to our LPs and just the market of what we do offer. And it really is helping two types of companies. One is the early stage fintech or CapEx heavy company with receivables, equipment, traditional assets.
Right, let me just take a step back. Just even it's at a high level, what does Upper90 do? Because you're not a venture firm, you're sort of a credit. Just what's the core product or like the value proposition at a high level?
The core product is we offer credit to solve complicated capital needs for companies. So we are a private credit firm that's looking for traditional assets that can be financed with debt, where traditionally companies are using equity, taking on a lot of dilution, and then thinking about venture debt as a tack on. That's the typical path, and it's very expensive for founders.
So it's like an earlier stage venture debt than what people are used to.
Well, I think of venture debt as underwriting the equity. It's like, does this company have a set of investors that will continue to support the business? The problem is, like we're seeing today, I mean, it's hard to underwrite venture. And number two, it doesn't really solve the core problem. If a company has assets that have some predictability and have good unit economics, they should be able to get credit for those assets. And that's what Upper90 provides. We don't look at who the equity investor is. We look at, are there assets the company has that can get debt financing, just like a real estate building would with rent. Venture debt is often good.
No, I was just going to say, where did the idea come from? Like, what's the genesis? Like, where did you wake up one day and say, here's an opportunity that is being underserved?
I was in finance for a long time in the electronic trading world. So it was using technology and building algorithms and looking at data. I always wanted to get closer to the tech world. I think that's where real innovation is happening. There's so many different ideas. That's, I'm sure that what interests you and a lot of your listeners. When you're in the finance world, coming out of college, and I'm older now, like, you went into banking or you went into consulting or you went to a traditional track. And it's very hard once you start there to then go to the tech startup world. You almost have to start over. You have to, you don't really get credit for like all the training and capital markets expertise and, all the great training in a place like Goldman Sachs. And so my thought was, okay, venture hasn't really changed in decades. It's just gotten bigger, and there's a role for venture. But if you think about it, founders should have more tools for growth. And I think what's really missing is thinking of how to bring credit and different forms of capital to the founders. And there's a lot of businesses where venture might not make perfect sense, or they have some part of their business that can get a lot of credit. So the reason I started Upper90, and I did it with my partner, Jason Finger, who started Seamless Web and Grubhub, was that you're just seeing that the founders are often raising so much money and making less at the end of the day than the investors, which is crazy.
Yeah. They were just far too diluted by the end of all, they were selling their equity, which is, by far the most expensive to sell. And just at the end of the day, they're not left with a whole lot.
Well, you've also had a double whammy because venture and growth equity has become gargantuan. If you look at the size of funds now and the size checks that they have to write, it's like an even kind of bigger problem. So that's number one, how to help founders think of different ways that they can set up their balance sheet for growth. Number two is equity is a very important but blunt tool. So you might have a company that needs to do an acquisition or has the opportunity to buy back shares or has the opportunity to buy equipment or do something funky and different. And we've felt like if you have a complicated capital problem, it's very helpful to have Upper90 in the complex. Because
and why is that? Yeah.
Well, because I think if you think about equity, they will often, look for very specific metrics to lead around. They have a very specific mandate. Like one of our companies, Octane Lending, which is a great successful fintech business, we initially started providing debt for them to do lending, which is, and then as they grew, they got cheaper bank debt. That's our job, like help season the book, help them graduate to bank debt, have some alignment with equity. But he's like, wow, I have a residual, which is, a type of lending. And the typical banks that I go to are risk off right now. And it's a really attractive kind of a complex structure. It's going to be outstanding for 18 months. You're going to get a coupon. Will you guys do it? And we knew the business. We were able to do something. Like, I don't think that would fit into a venture capital or growth capital bucket.
Yeah. And what about traditional venture debt, or just venture debt was dominated by SVB and?
Well, venture debt would say, hey, if you raise equity, we'll give you some debt. He's like, I have a really good trade here. Can you solve the problem for me? People have working capital. They have liquidity issues. Like in life and business, you just have things come up. And I think our view is that there's a role for somebody like Upper90 to just be like a problem solver on the capital side. And so we have the flexibility to solve a wider variety of problems. And often these problems are temporary, right? So if you raise equity, like you're raising permanent capital for a temporary solve. And so our view is like, let's match, there's a temporary problem, we'll be compensated for it, but that company's better off because they don't have to have like a mismatch.
Yeah. So it's interesting. So it seems like, and maybe I'm wrong, like what you talked about at the beginning, where you said, coming up, leveling up in the finance world and fairly sophisticated, right? Like, whether it's high frequency trading at Goldman, whatever it might be, it's almost like you are the culture divide a little bit, right? Like, in other words, a VC is somewhat, well, it's gotten better, but like, it's somewhat isolated from mainstream finance. Like they don't have as many bag of tricks as traditional finance might have.
Yeah. I think you're going to see a big shakeup in venture. I've been saying this for a while. Venture, if you're not a top firm, is very similar to what I witnessed in like long short equity when I started. Like you see a company and you're just betting on people. I mean, there's not that much data to underwrite a business. And, you're saying, oh, I think that this company that's, financing heat pumps for, the US consumer is going to end up having this huge I mean, it's so much of it is very subjective information and underwriting. And look, if you look in the stock world, you've just seen, between ETFs and quant funds, and it's really hard to be paid a lot of fees to be a stock picker.
Yep. Yeah.
They just don't beat the market on average. And so I think, there's going to be some, you're looking to big venture funds are getting bigger and they're, trying to have lower volatility and having more fees and, they'd rather trade returns. Like, I'm just going to have lower returns, but I'm going to run more money. So I just think you're going to see a lot of the smaller funds, I think, are going to have big problems. And it's just a tough time to make money. There's a lot of people on the sidelines. And so I think there's a lot of problems creeping up. Like just in the last week, it's like we saw a company that is looking to buy their biggest competitor, and they're buying it at such an attractive level, they'd like to use debt to do that. And so that's an opportunity. And, somebody in our portfolio, we've been financing NVIDIA H100 and H200 GPUs, and they were able to take over somebody's order that wasn't able to come up with the money and do it in a really quick, attractive level. And like, that's a good debt opportunity. So you kind of need this fast, flexible credit. The key is are there assets that you think can pay back your debt? Like if the
So how do
company
you
goes
how do
defunct,
you
how do you
get comfortable though? So first of all, that's a good decision. So you're actually like you were collateralizing hard assets, not
Yes.
necessarily. It's not like SaaS like lending. You're not lending against revenue or ARR or anything like that, or are
No.
you?
Very selectively,
Um,
if we knew the company in and out, but that would be a very selective. We're not smart enough to pick who's going to be the right customer and the right, consumer brand or
at what point
product.
our ARR decays, and so
Yeah.
how do you get smart on so many different asset classes? Then, like, how do you know how to underwrite, GPUs and I don't know, whatever it is. I mean, name your asset
It's a
classes. But
challenge. So,
is it
we have a team of about 20, and I think you just have to kind of go back to basics. And if it's an asset, like to give you a couple different examples, we just recently financed the largest truck driving school in the country. So they buy long
okay?
haul, they have big trucks, they have big facilities. They're training long haul drivers for Amazon, FedEx, UPS. They're a big employer of the state. So you're like, okay, they needed debt to grow. So they have trucks, they have contracts from the state, they have contracts from enterprises, they have a lot of history. It's a profitable company. So you might say, I'm willing to give a loan with a higher advance rate, or effectively, I'm willing to giving them more capital because I understand the asset, and it's more of a mid-market PE style business. Their issue is that their lender was ending up maturing, they didn't have a fund to continue extending, so they needed to do a quick refi, and so we stepped in and solved that problem.
Got it.
In the
So in some
NVIDIA,
ways, it had already been underwritten. You just had the flexibility to move
yeah, and
quickly
like
and
one
take
of our
advantage of.
LPs
Yeah.
saw it. They didn't want to go raise equity to refi the debt. We were able to step in and solve kind of a complex problem relatively quickly because there was already a lot of data. The company is profitable, and we understood the assets. Like a truck has kind of clear independent value to this startup or to another business, right? NVIDIA chips. We started financing this space a few years ago. So one is you have to find these ideas early. There's so much money out there. Like if you're not early, these things become very efficient quickly. So the key is finding the opportunities early. And we've built our LP base. We have hundreds of LPs. Most of them are business builders and founders. Most of our deals come from that network.
Hmm.
So they see an opportunity, it's brought to them, they bring it to
Was
us.
that deliberate from the outset, or did that just sort of
Deliberate.
emerge as a sourcing edge? That's
I've
interesting.
always felt, and this is a huge thing, if you have a good deal, there's always money. The hardest thing is finding deals.
Yeah.
Like most of the people we compete with in the private credit world, they all come from finance. They're like, I worked at a bigger fund or a bank and I want to go to a smaller firm and be more flexible, but they don't look like their customer. They don't have any connectivity or empathy for what exists in the startup world. So the first thing I did with Upper90 is said, hey, I feel like I have a good sense of the underwriting and the finance world. I have connectivity, but not real experience in the startup world. And so I spent a few years trying to convince Jason Finger, who started Seamless Web, which then bought Grubhub, and a really prolific investor and founder, to come do this with me. And then from there, we ended up kind of bringing a lot of people from his world and my world into Upper90. And that really was the nucleus of it from the beginning.
So it's like a combination of like VC founder network on one hand, and also like more traditional businesses on the other
The
side.
quant network on the other, and those worlds never really combine. So you might have a business come in that has a great use of credit. Like the startup world, the founder world's not going to think about that. They're going to be like, yeah, you have a great business, go raise equity. When those businesses come into Upper90, the founders on the quant side are like, wow, like why isn't this company using credit to finance a Netflix contract or whatever? So with NVIDIA, we're not smart enough to know how long is the current NVIDIA chip going to be useful for, 1 year or 7 years? Like no one knows how quickly the next chip's going to come out. And so in that situation, what you do is you say, you know what? In the truck, maybe we'll finance 90% of the acquisition price for a truck. For the NVIDIA chip, maybe it's 50 cents, right? So you're going to have to raise more equity. We'll give you some debt, but we need to delever it because there's more risk. So I just think you just kind of have to look at each situation. And really what we want to stay away from are things where there's a binary outcome that we can't really predict. So like healthcare, there are firms that underwrite royalties for healthcare, or a drug going from phase 2 to phase 3. Like you can probably say, there's some predictability and some credit you could get, but there's also those binary outcomes where you rather be equity. Like you're just not getting compensated for those black swan events where it just could be zero. So we've not done cannabis lending. We haven't really done, if you remember, income sharing agreements where people can sell equity in themselves. So those are all in that gray area. And I feel like in those kind of situations, you'd rather be equity. We just want to find situations where there's an asset that we understand and like can align with the founder for what the right, is it all debt or is it partial debt just based on the unknown uncertainties?
Are you guys doing any like industrial or hardware stuff? Like, I mean, outside of NVIDIA, obviously, but like, it's become a more compelling asset, whether it's the reindustrialized, American gearhead thesis, that kind of stuff. Like, are you seeing more of it?
I think that there's just such a big opportunity to bring different types of capital to the startup world that, we're not having to go too far on a limb. We saw a company that's building electric lawnmowers for golf courses. Like super interesting. They get, but our view was like, if the business went defunct or demand,
what are you going to do with a lot of electric lawnmowers?
Like it's a very bespoke product and we couldn't really get comfortable. In another situation, there's a company we're talking to that's built a very successful mobile dog grooming business, kind of with some tech automation for, more density and, upsells and scheduling. Their biggest expense is a Mercedes Sprinter van. Like that kind of makes sense. Like that we can finance. So it's kind of finding interesting businesses where there's an asset that we think we can be helping the founders with dilution. And then ultimately, if it works, allow them to keep growing with us.
And their bank is just too slow-footed to do that kind of thing. Like, I mean, that's just like it's an auto loan, right?
Well, I think the key for us is finding the companies at the right time before they've raised a really big equity round. Like, I think when you're thinking about a round and you have some asset that you think has predictability or salvage value, a lot of people think about, I'm going to raise equity, then I'm going to think about debt. And I would just encourage founders to think about them at the same time, because
concurrently. Yeah.
Yes.
Do you think that there is, how big is Upper90 now? I guess
Sure. So our latest fund's a little under $400 million. Our total AUM is over $1 billion. And we're typically doing kind of like $10 to $20 million facilities for companies. And they could start with 5. We'd like to find companies that, have some product market fit, have already done some element of the business, and we're liking to help institutionalize it. But I think it's a nice spot because a lot of the firms that we compete with or people are familiar with on the credit side, they've gotten so large that they're looking to, do $50, $100 million facilities. And I feel very strongly that as a founder, in an earlier stage company like Series A, call it, you're still figuring it out. Like you want someone who's going to help, with setting up the facility and helping you with the underwriting and, helping you kind of get to bank debt and a cheaper cost of capital. So I just really encourage founders, like think of who's going to be the best partner at this phase of your business. And then you wouldn't talk to a PE firm for your Series A. Like, why would you be talking to a bank for your first debt facility? It's going to come with a lot more inflexibility, and flexibility, certainty, then cost are the most important things because you're really trying to minimize dilution.
Yeah. So I guess then on the LP side of it, I'm just sort of curious and pulling on the thread, like what is their return? Do they get dividend? Like how does because if you're doing debt and equity, And, obviously equity and VC is a fairly long hold time. Debt, for the opposite end of the spectrum, is generating,
Yeah,
cash off of it. So how does that work?
for sure. So, we think of it more special sit or opportunistic credit or hybrid credit, love to try to narrow it down. But think of us as we're a credit firm where we do 90% of our capital directionally in debt. 10% of that is in equity. And what we found is we want to do deals with companies where we don't just feel like they have a good asset that can pay our debt back. We're also excited about the business. And life's too short to just, kind of lend money and not care what the company does. And I think a lot of people think that way. So, and then the second thing is, we often want to be aligned with a company. So by having some equity, even though it's a smaller percentage, you're motivated and aligned with a company. Often a lot of lenders, they might make more money when there's problems because they can charge penalties and they can exact pain. So I think, like, if I was starting a company, I would almost demand that my lender had some skin in the game. Otherwise, like, if things go right, it doesn't matter who your investors are. Like,
Right.
it's when things go wrong,
Everybody's
how to
happy.
react.
Yeah.
And
Yeah.
I'm just shocked that, like, we see just so many bad behaviors and it's not really talked about.
Well, the
Where
other
people
thing,
are getting
there are
screwed.
bad behaviors on the investor side, you mean? Yeah.
Yes.
Yeah, no, it's interesting. I mean, right, when everybody's chummy when times are good, and when things
Yeah.
get sideways is
We
when
put our
the
money where
costs
our
come.
mouth is often. We'll do a smaller amount. So it's very clear to investors, like, they're looking at this as a way to get, an attractive mid-teen return and, having a little bit of a kicker, but that is the sequence.
Are you seeing more of the? I guess it's not creditor on creditor violence necessarily, just because you may be the only lender there. Are you seeing more of that now?
Definitely. I mean, I think it's hard to make money. Like, what I'm observing is the early stage part of the market has existed similarly to what it looked like a few years ago. Like, seed rounds are getting done at directionally the same prices. Series A rounds, I think, are getting done at directionally the same prices. And those early stage companies have no drama. There's no issues, right? It's a new idea. And so everyone's like, wow, this is a
Yeah.
blank slate and it's a great idea. And, like, you could just look
It's like
forward.
the industry has pushed a hard reset on new vintages, and everybody's just politely ignoring all of the money that came in over the last 3 years.
That's
Yeah.
right. And so it's like, oh,
Yeah.
so I think that there's been a lot more, like, in the messy middle. Like, there's just good companies, but the growth equity is still on the sideline. Public markets are still directionally shut. So we've been able to kind of be a problem solver for a lot more of these, like, Series B to Series C, maybe D companies that have kind of a short-term complicated problem. And it's just because I think there's just less capital availability in the later stage part of the market versus early. And, a lot of it's like people just don't want to deal with complexity and, kind of they have a
They
very
don't know
tight
how.
box.
Yeah. Yeah, I mean, it's just so you touched on a few points, and I kind of want to ask them. I'm not sure what. I'll just ask them serially. So
Sure.
one is, it's like, and I saw it on your website. You just alluded to it. It's like there are some startups that are they're not built for hyper growth. Like, maybe they thought they were at some point, but they
Yeah.
put a lot of money in. They've it's expensive capital to sort of turn over the cards and build some technology, find some early product market fit, but they've hit this point where it's like they're hitting a growth wall, and maybe they raised at some exorbitant valuation that the equity's forever underwater. And like, but as a going concern, like, these could be good business. Like, most businesses aren't hyper growth businesses, right? Like, most
Yeah.
businesses build slow and steady. So what, like, I have this, I'm sort of on this kick, and I'm sort of doing more discovery around it. Like, what's happening to these companies? It just seems to be like a weird, it's like incentive misalignment, because the existing pref stack, why are they going to be motivated to do anything? They'll hold on to their lottery ticket, at least for now, or just kick it down the road. But like, it just seems like a bad outcome, for the founder, for the company. Like, it's just, I don't know. Like, so are you seeing?
I know
I
what
mean,
you
are you?
mean. I mean,
Yeah,
I
yeah.
think a lot of people are trying to delay things in hopes that rates are going to come down and markets are going to go up, and all of a sudden all this tough times
Back to
are just going to
normal.
be
Yeah.
gone. And the reality is, like, a lot of these companies will go away, and a lot of these funds are, just holding on so they probably don't have to remark their books. And I just think these companies a lot of them will go away. A lot of these funds will go away, and it's going to be a bit of a cleansing. Look, I think you need people that twofold. One, we've worked with an increasing number of experienced, like, second and third time founders that are either like, hey, I want to build this business a different way, like that mobile dog grooming business. And if I own enough, like, $100 million outcome could be equivalent to $1 billion outcome.
Right.
So that's one. Two is, and I think you're seeing more and more of that.
So what do you do? So you just let me stop you there. So, like, what do you do? I mean, I think that there is a substantial class of those. Maybe I'm wrong, but, like, I think that there's a bunch of those companies that exist. So if you get in early, great. But what if they've already raised a lot of money? It's like they could dial back their spend. They could become break even or profitable. They've got money in the bank that they're clipping 5% on. Like, they could go on for a long time, right? Like,
For sure.
um,
And that's a good thing. Like, if you can control your destiny, that's where you want to be. I think your question was like, hey, there's a business that isn't profitable, that has a huge debt or pref stack. What happens? And so, in those situations, I think you gotta, directionally be careful, because more than less of those will die. Too much complication, too much leverage. I think that you need to find a really passionate founder, that is like, I want to clean this up. I want to keep running this. And I think a lot of people, when things get tough, the grass is always greener. So there's a fund, Zig Capital, that, kind of help.
Sure.
I don't know exactly the business. They did a cool recap in Europe. And, we've seen situations where founders are now thinking of how to buy back their business and give people some exit. Maybe it's not perfect, but, somebody has to step up and take charge.
Yeah.
And that's typically how private equity thinks. Just a lot of these situations are too small for that. So that's some of those things we try to be in the middle of. But you really need to find a great team, a great founder that you can back. I think that can't be investor led.
Yeah. So I just want to break those. So on the first chunk, let's say that, the company can be operated as a going concern, but the equity is all underwater. So what the CEO, they get a salary, they get the prestige, but there's very little. What's the incentive to generate extra profit at that point? And for the investors, like, they say go, 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 right? Like, for them, they want 10x outcomes. They don't want a lifestyle business. Like, are you saying that those are they're just going to ride it out for a while, and at some point, like, what is the
Well,
the
I
fund
think great
has to?
founders are not interested in a job. Like, so I think in that situation, the equity or the debt, their goal is to get their money back. They're like, this thing's in distress. How do I get my money back? So on average, the CEO and who's there because he's an entrepreneur might leave. Is this not what I signed up for? And, the other group might bring in somebody to help try to, do a merger or try. I think at some point the goal is not 10x for the investors, it's 1x. That would be a win.
At best. Yeah.
Right.
And their LPs
And so
will love
it's
it.
just a mindset shift. And then when the goal is to just get your money back, like, you're not going to, in my view, attract the best talent. You're kind of working for someone else to get,
you got to recap it so there's some skin in the game, for whoever's coming in afterwards. And, like, as you say, like, founders, they're not working for a salary. They don't want a job, but they may be inclined to, like, build a business the old fashioned way, right? It doesn't necessarily have to be $1 billion outcome.
Yeah. I mean, we're looking at a deal right now where they've been rolling up software companies with really good metrics and not, an ability to show post-acquisition growth. And the lender that they have to buy these assets has really been not as supportive of the business and would rather get out than do more. So that's a situation where someone introduced us. We've come in, we've underwritten the business, and we can come in and take out the lender. And I think it's like finding those situations where there's a team, it's a good business, and there's like a capital problem.
Yeah.
we're a really good thought partner and problem solver. And I think that's the kind of situations we want to see. And it's often partnering with the equity.
Yeah. Are you doing like, I mean, are you doing like any like leverage buyouts or anything? I mean, you mentioned, you sort of alluded to it before, either people trying to buy back their equity or even something like that, like a roll
We'd
up.
like to see, I mean, I think there's going to be more of that. I think there's going to be more founders who have, we didn't do it, but, when WeWork bought a lot of those assets that weren't strategic to their business, and the founders, a lot of them ended up buying them back, at a fraction of the cost. Like, I think we want to see those situations. Like, if you have a business that you're excited about as a founder, an investor, as an LP, as a VC, we want to then help you think of how could we restructure this? How could we take out the lender? How, like, those are the situations you want to see, but it starts with somebody who's really excited about the business, and we're that capital markets partner to solve the problem. Like, that's how I think of us.
Do you have you guys gone through a bankruptcy yet with either on any side of it, either as a creditor or
I think the traditionally, it's costly and expensive to do that. They end up kind of getting worked through some type of restructuring, but the answer is yes. And I think in 2021, 2022, there was just, in certain industries, just way too much leverage that were put on businesses. And I think that everyone kind of looks back and is shocked at just, how much debt, was kind of allowed. And it's tough to work through that.
So I'm curious, like on the sort of state of VC generally, it's like, I mean, there's two things. One is like, okay, let's put aside that, the past one problem is the past couple of years, which there was just way too much money chasing way too little risk. And not only that, like, the goalpost moved in terms of, just the cost of capital, right? Cost of capital went up. So everybody's, just basic DCF says that you want to move further, your anticipated returns just have to be higher to justify that kind of risk. So that, I mean, that's thing one. So obviously that's, caught a lot of people, out in the open. But thing two is like, let's even putting that aside, is like, there are other arguments around, like, has low hanging fruit been picked? Are certain, how much more SaaS can one possibly invest in? Like those, do you have views on that? Like, do you think that there's a new kind of like the guys at Slow, right? Like who I spoke with before, who pointed me in your direction, like, do you think there's a new kind of VC investment model, or maybe that doesn't require $1 billion outcomes every time, or tries to do something different, like they're from like an opco kind of play? Like, have you gotten interested in those things?
Yeah, I think that's part of our thesis with Upper90. With the right capital structure, there are a lot of businesses that make sense. I mean, private equity is a great strategy. Buying assets and rolling up assets in a lot of, from medical to ed tech to sports. I mean, it makes sense.
They're not returning a lot of money to their investors either, though.
Well, right? But they're buying profitable businesses. Like, the returns might be muted, but I still think the strategy makes sense. Those companies make money. They have good unit economics. There's not as much free leverage, so the returns will come down. But like, it's still, I mean, I think it makes directional sense of, franchise model, with I think you're just seeing that applied to more industries. From pest control, we saw a company that is rolling up pool services businesses. Like,
some of those guys are in trouble, right? I mean, because pool services was sort of a discretionary spend. And
well, but it's all about leverage. Like, if you're buying things at a reasonable price and those businesses have a reasonable margin, it goes back to what I was saying. Like, if you finance the NVIDIA chip with a low or attractive enough LTV, like, there's room for error. You just got to find things that you can buy at a reasonable price that have a reasonable margin. And I think that you can win. Those are not like 100x, AI venture returns. So the answer is yes. I think that there are roles for that. And it's harder than it sounds. The joke is, the Stanford graduate now is going to buy a HVAC business in Iowa, and so I think there's probably some hype that, hey, I don't want to go to venture. It's tough. Like, I'm going to go buy a SMB business. Look at all these people retiring, and I'm going to go and roll up accounting practices and
pest controls. And exactly.
Yeah, we see a ton of those. You just can someone actually buy something to get better? Yeah, tons of those. Yeah. But those things, I think, done well, there is a role for that. So yes, I think there's going to be other areas where you can apply kind of that private equity mindset. I'm more of an optimist. Like, I just think technology evolves. There's always new things to finance. Like, college students now can get paid like professional athletes, right? And so there's a
Yep.
whole market to finance contracts that their college athletes now have from Nike. So
Yep.
there's a whole industry financing professional sports contracts. Now there's a whole new industry that's financing college athletes. So I just think there's always new problems to come up, and it's harder to make money, and it takes more time to kind of find these things. And I think that it's going to put strain on venture overall, especially early stage, because you're not going to have all these just immediate home runs. Like, AI is exciting, but as I understand it, some of these like seed rounds are $50 to $100 million valuations. It's like, that's
It's almost like
crazy.
they're doing the exact same thing again, right?
Well, it's just that you have to have such a big outcome. So what I think is that what Slow's doing on the venture side, what we're doing on the credit side, it's more hands-on. It's more operationally intensive. It's going to be hard to be like a 2 or 3 person venture group to do all the things that we're talking about here.
Yeah. To do all the underwriting and
not like
the
a set it and
servicing
forget it. I put in $100K or $1 million, and I wake up 3 years later and I've made a couple introductions, and the company's worth so I think it's just going to be harder to be a smaller asset manager.
And also, at the end of the day, money is fungible, right? Like, it certainly at a certain size, once the company already has, like, it just becomes an auction, and then it's like, how do you differentiate? What are you going to say? Like, unless you actually bring some operating leverage to the table or something truly special, like, at the end, you're just going to be competing.
Our view
price.
is, like, if you talk to Jason Gust at Octane or some of the companies like Crusoe it's just good to have a firm like Upper90 in the cap stack, because you're going to have a problem come up. Like, you might have a really efficient bank facility to finance NVIDIA chips, as an example. And let's just say AMD comes out with a really attractive chip that's outside of the buy box. Okay, who's going to now finance the AMD chip? Like, just, things come up. Like, I run pool services businesses, and I never imagined that I could buy a pool cover business. And now I have a whole, like, I just think as you grow, other things come up. And like, I think it's just good to have groups that can solve a wider variety of problems in your capital stack. Everyone's like, I have 6 VCs in well, they all are helpful, I'm sure. We partner with them, but they're all solving the same capital problem.
Yeah. Yeah, no, that's exactly right. So, like, so what's your, like, just taking a step back, private credit, right? It's grown enormously. I saw some data the other day that just, like, even they're also, like, from an allocation, but from a deployment standpoint, right? There's all the private equity shops, almost all of the money they deployed has been credit recently. There's very little, like, they're not doing that much equity deployment. Like, is this just the new banking? Are banks forever out of this business? And then it's just, it's just investor risk capital that's being put to work as opposed to a deposit. Like, where is it? Do you think it's going to get 3x bigger? Do you think it's going to top off? Is it going to get too big? Like venture got too big? Like, what's your general view on?
I mean, there's clearly a lot of money out there. I think banks are always going to evolve and be competitive. So, I think that will just kind of naturally keep returns stable, because there are a lot of options there. I think it's good for companies. Where we fit in is, like, we want to be kind of that first capital partner or that complex capital partner. And we're, again, doing $10-20 million deals. Those big firms need to do hundreds of millions of dollars. So I think a lot of those firms, like, if they think that we could partner with some of the bigger credit firms, because, like, they are looking for deployment. I think our view is that let's get involved in these companies earlier, give them another muscle in their system. And there's a lot of companies out there that have done an exceptional job, like Sixth Street or others, that, we could partner with if the company needs. Like, we've done our last couple of deals. One was 50s. We're doing a $200 million upsize. We'll partner with other people. I just think there's too much money in the system, like, right now. Like, there's still a lot of money, even though rates are up. chasing too few good opportunities. So I just feel like things are too tight, and we've just been really patient deploying. But I don't know, it just feels like it's too tight versus the risk you're getting paid for a lot of
Yeah.
these debt deals. People are
What?
prioritizing capacity versus rate.
Right, because they make money on fees, right? I mean, isn't that
Yeah,
part of the,
exactly.
but the what about like NAV loans and some of the continuation funds? Like there seems to be also a lot of incest, for lack of a better word. Like there are different sponsors who are lending, they're sort of lending amongst themselves, lending against their own family of private equity managers. Like is that like just is that a ticking, I don't know, like should people
I
be
don't know.
alarmed
We don't
about that, or
really
is that just
play
like
that much there in that world.
yeah.
So, we had a GP that we're familiar with. They had a company they're really excited about. They had an ability to buy that warrant that they had negotiated years back at an attractive price that was expiring. They came to us. They needed $13 million. We gave them a loan that was securitized that they allowed to buy a position in a specific company, which again, we're not smart enough to underwrite a company, but they
Yep.
then pledged all of the assets in their funds, and they pledged other assets. So I think that, again, that's more like a special sit. I think there are a lot of funds out there that are doing secondary and NAV loans and, kind of creating
Yeah.
liquidity for LPs. I think it goes back to where we started this conversation. Like, you're buying in at 50% of value, but is that the right value? It's like
Yeah.
baseball cards were worth a ton during COVID, and somebody came to us and said, will you lend money for us to buy baseball cards or lend money against our baseball card inventory? And it's like, we only want 30% of the current value. And Jason and I said, well, I mean, if 2 years ago, that would be 120% of the value. So
Right.
I just think it's all relative. I just think it's we don't do that. I think it's almost like timing the market. Like, hey, we think there's going to be this stabilization or uptick in values. I don't know. I think a lot of these things could get worse.
Yeah, it's like, I mean, there's no question the sponsors would be prefer, they prefer to generate liquidity by selling these businesses. They can't sell them because the bid ask is just way too wide, and they can never fetch a price that that would get them the return. So they're borrowing against them to generate those returns, as though at some
But there's
point in
good
the future,
businesses.
what
Like
like
Stripe
yeah,
is a great business. Ramp is like, those companies have an
but
active
at what
secondary
price?
market. I think it's just more of
Sure.
there's more of like, there's less of this, like there's going to be like good and bad. There's going to be less in the middle, like most
Yeah.
businesses.
So why don't more people do, like, it just seems interesting. Like, you guys are so flexible. You will do almost anything. Like, I mean, subject to the, your diligence requirements and how you think about these things. But like, why aren't there more people playing in
Well, I
your
think
space? Or
family
maybe there are.
offices have typically done a lot of this. There are more, private credit firms like us entering. I think it just goes back to, we've spent a lot of time. We have, hundreds of LPs that have been built, similar to Lead Edge Capital. Like, we've really cultivated a very unique group of LPs that see interesting opportunities and know the types of situations and trust that we will solve it and make it better. We roll up our sleeves and we're willing to do smaller deals. I think a lot of the people, like, they want to do what we do, but with the goal of making a gargantuan firm. And
Right.
so, and also not many firms do a little bit of equity too. So I think a lot of it's like the way we built our LP base, the size of our fund. And, there's not many, like, if you interviewed all of the other groups and said, hey, there's one co-founder that came from finance, one that came from tech entrepreneur world, that probably doesn't exist. It's like, it's more like restructuring, finance, credit. So I don't know. I think that there's a alignment and empathy, and that's where we started this. Like, how do we help founders solve problems versus and if you find companies that way and are a good, value added partner, like, you're going to, I think, earn a good rate of return. Like, if you
Yeah.
come into a situation and be like, oh, this is distressed and I can charge all these fees, and, like, ultimately you're just going to get some negative selection. And I just don't think that will persist.
Yeah. Right. And so, right, for them, like, people are sort of constrained by both like the LP expectations and the size of the checks that they're writing, and like if you're an allocator for a pension or something like that, you presumably you have certain boxes that you have to allocate, and if the target's a little unusual, like maybe like you guys, like what box do you go in?
Yeah. And a lot of lenders, it's more like, as you said, sponsor backed or equity backed. So I think it's like a little bit of our strategy before venture melted down was like, hey, there should be some more innovation. And maybe at the time, venture and growth equity is making too much of a return.
Yeah. At least on paper, yeah. But it's interesting. Okay, so the other question I was sort of curious, like, what's your sense of like what LPs generally are thinking right now, or like are they cautiously optimistic? Because like there's just so little liquidity that's been coming off of private capital investments for a while now. Like, I mean, I saw some data that's like, I think that like the fund vintages going back to like even 2019, like the share of them that had a 0% DPI that just returned no cash was something like 40% or something. Like, it was really high.
Clearly, people are not happy about the lack of liquidity. I think a lot of people are very selective about venture deployment. There is a role for venture, and there's some excellent venture firms that we do stuff with, like you mentioned, Slow and Interplay, and just there's a lot of firms doing niche cool stuff. So right now, people are upset, like, why wouldn't I just put my money in the stock market? And it's gone up a ton. And why I'm sitting in 5% savings accounts, and I'm, earning 15% from private credit. And so right now it's like hard for venture to like compete with that, right? That narrative.
Yeah.
And so, real estate's up. And so I don't know what, probably no one can predict the future. My view is that some of these other asset classes are probably going to end up earning less and having issues. So like the stock market probably corrects, and everyone's like, okay, crap. Like, I need to now to think about private equity and venture again, or, there's too much money in private credit, and these BDCs and these companies are going to have more defaults. Like, how can like venture and all these people saying, wow, we're having so many troubles with our portfolios, and all these companies are not doing as well as we thought. And like somehow all these loans are performing in current. So there's like, I just think you're going to start seeing some of these other asset classes also having some issues. And then everyone's gonna be like, okay, like venture and private equity is a role for it. So I think, you just have to survive some of the cycles, but that's how I think about it. Like right now it's a trough, and, I think that will change when some of these other returns normalize.
When rates change, like, very suddenly, was it like, what was that like for you guys? Was it like,
it's not as relevant to us because, most of our deals are floating rate. We're financing companies that have good profitability at their asset level and can finance the debt. So, if it's lending, they're charging their customers 30%, they can easily service Upper90's 15%, or, they're, the trucks that we're financing have like a value above the amount of debt we've put on the trucks. Like, so I think that we've just looked at businesses that have like what I call like excess spread. Like they're earning more on their assets than they're paying us. And that's what we look for. So I think if rates come down, it's probably a net positive. I think the bigger challenge,
I just mean, even going back is like, sorry, I didn't mean to cut you off, but like back in 2022, like everybody, myself included, was fairly persuaded that there was like there was a recession around the corner. That was the whole point, right? Of raising rates is, it's just, were you guys just didn't care, like cautiously optimistic?
I just think
like,
there's enough companies that like, there's just so many of these opportunities, like Upper90 opportunities where, you have an NBA player and his contract's guaranteed by the NBA, and he wants some of that money now versus each year for the next 7 years. Like he's willing to pay some type of spread to get that now versus in the future. Like, there's just, the company or portfolio PayJoy, they've built technology where people can finance their cell phones. And if they don't pay the cell phone back, they can turn off the cell phone, which is, after their house and food, probably the last thing someone wants to be turned off from. Right. So there's just all of these innovative things where it's a new market, it's inefficient, and there's enough of a premium you can charge versus like the rates you have to pay. But I think the bigger challenge is a lot of those companies, it's just harder to raise equity. So it's just harder for these companies to grow. And like, so I think the bigger thing is just like the helping think of like, what's the right, like complete balance sheet look like. And that's why I think it's important to get someone like us or us, if you're the right business, so you can kind of make sure that you're growing and have optionality. Like if your only way to win is I have to go raise the next gargantuan round of equity, like that's hard.
Yeah, certainly now. And this is it's not necessarily a great value proposition given how expensive equity was before and, will continue to be. Yeah.
So I think, it's for a lot of second, third time founders, but I'm going to have to run in a minute, but I just think it's all about finding these opportunities at the right time.
Let me throw a couple just sort of one-offs. I'm sort of curious, like if you had a magic wand in your business, what would you use it for? What would you fix?
I think raising money, it always takes a lot of time. I think we're great, like finding deals and leveraging our network and helping founders solve problems. So, if there was a way to partner with a much larger permanent source of capital, I think we could spend our energy and time on like what we do best. And, there's a large fund or a source of, sovereign capital that I think, who knows, that like would allow us to spend more time on deals versus capital raising. So that would be something that, jumps to my mind.
What's the thing that you've been wrongest about or changed your mind the most about over whatever time horizon you choose?
I think that diversification, like we just ended up investing too much into certain theme like e-commerce and the aggregator space. And, I think that, we did some things right, but we also didn't, get out as much as we had hoped or hoped the public markets would, just more timing. So I think it just, especially in credit, having greater diversification is a good learning. And just because you can raise a lot of money doesn't mean you should. It just puts you on a certain treadmill that may be unhealthy for a business to grow too quickly. So those are like just two things that
and it's true on the investor side too. If you raise a huge fund, you've got to deploy, you got to generate the returns you told your LPs, and like it creates perverse incentives.
It just, it's hard to do anything. Like great businesses are built over time. I just think you can't, so much happened like in 1 year, one company had like raised 3 rounds within a year. It was crazy. And I think that's just a learning.
Is there a thing that you believe now that most people think you're wrong about?
That probably that we can run a small to medium sized fund. I think everyone thinks like you have to be huge to do credit. And, our view is that we can find good problems to solve and like kind of derivative opportunities are created around it. And I think that's, everyone's kind of trying to, if you're not huge, you're irrelevant. So that's kind of like maybe a counter perspective that we've taken.
All right, last question. If there was like a game of Survivor and you had a private equity VC team, a hedge fund HFT team, and like a founder team, who would win?
I think private equity is probably the best skill set. Like you have to understand how to underwrite a company, structure a company, like raise money, identify talent. Like I just think that is, if all of us, had those
do the most
skills,
things.
I think that's the most complete strategy and the most predictable and reliable that I've seen.
Interesting. All right, great. This was great. I appreciate it. I'm going to
thank you so much. Hopefully we'll find some more deals to work on, and anyone you think we chat with, at the founder or investor level, like that are thinking this way, it'd be great to connect with them.
Yeah, for sure. I'm going to end the recording, but thank you again. And
thank you.
Yeah, I'm excited. Yeah.